All right, we are tracking Canadian Western Bank, which has been, its namesake suggests that it is Western exposed, but has been moving east over the course of the last decade and has been seeing big growth in places like Ontario as well as Quebec. 2024 is going to be an interesting year after unprecedented rate increases. We are expecting to see rate cuts. What does it mean for the Canadian economy? What does it mean for some of the businesses out there? Banks have certainly been very hesitant to lend in this environment. I'd like to bring in Chris Fowler, who is the president and CEO of CWB Financial. Thank you so much for joining me, Chris.
Oh, it's great to be here, Amber.
So this should be the year, right? 2024 of rate cuts. We're pricing in a number of them this year. How are you as a banking executive thinking about the magnitude of rate cuts that might be delivered?
Well, I would say it's a wait and see. I mean, we've had four Bank of Canada announcements where they have not increased the rate. And I think they definitely gave signs in the last announcement last week that they see the economy as not being overheated. They're seeing some excess supply, but I think they're still very, focused on maintaining their view of where is inflation going and what are those underlying pressures. So, I think we've had some optimism in the markets of anticipating rates to come down sooner. So we'll see where they go. I mean, from our perspective, we've kind of said the second half of the year to see some rate decreases. So the transmission of monetary policy is a lagging effect. And so we do anticipate that. And we are seeing the economy be slower than it was, for sure.
Yeah, I want to unpack that because you've got that window into businesses, their accounts, and business leaders. The other side of rate cuts is that there's a slowdown, right? Although some say maybe there's this unicorn event where we get growth plus rate cuts. What does your insight tell you with your finger on the pulse of how businesses are faring right now and how steep a slowdown might be?
Well, I would say what we're seeing in our client base is we're getting people being very careful, as they are looking at their decisions on investing. I think cash is a big challenger for loan growth, when people are actually deploying cash to reduce debt, just given the high cost of it. We're definitely seeing lines of credit being kind of paid down and not really a lot of debt being taken on, and new projects being really determined when do they start based on what the rate environment's like. So, I think there's a bit of a push and pull on the rate environment, and I think people are just being very careful, just given the rate levels that they're at today.
I'd love to talk about your real estate exposure. I know it's not a big part of your portfolio, but you do have a window into that, particularly kind of on the office side of things. What could a rate cut do to demand in that portfolio? What part of it is challenged? What part are you waiting for certainty before you get more aggressive?
So we participate in the construction side of that equation for commercial real estate construction, which also includes residential construction, and we're also on the commercial mortgages side. We have a very low percentage that would be in office. We're much more in the industrial sector because that kind of fits our core client, that business owner client, much more appropriately. And offices are really kind of a bigger ticket entry point than we would typically participate in. We do have some office, but it's a smaller part of what we do. As we think about interest rates in that, if we think about construction, we definitely are seeing people being, very thoughtful about, particularly if it's residential construction, what's the pre-sale environment. So if you've got the affordability of your buyers wanting to come in with a residential mortgage with a pre-sale commitment, and they have to put a deposit on it. So I think, there's a lot of care and forethought going into the developers deciding when do they go forward and how do they think the depth of the market is given the interest rate environment that we're in. So we are seeing that being slower than it was, absolutely, with these higher rates we're in. And on the commercial side, same. Again, it's just determining what is this opportunity. So if I'm a landlord and I have a tenant opportunity, does that re-tenant an existing building, or is there opportunity for growth and adding new product? And it'll all just depend on what that demand would be. And I would say the last few years we have seen more demand on that industrial side, particularly the logistics area. And again, this will be driven by the interest rate environment as well.
How are you thinking about the knock-on effects of this impending mortgage cliff that a number of Canadians will face, having to refinance potentially at higher interest rates? Not obviously what it means for your actual business, but the thinking is, or the fear is that it's going to have a ripple effect, right? It's going to cause a slowdown of the Canadian consumer that now has to allocate even more to their mortgages. And that's going to wash up on your shores potentially with businesses struggling. How are you thinking about those linkages?
Well, we're certainly looking at that for sure, because I think the big year is sort of 26, 27, as we think about when 5-year mortgages were booked at low rates and are coming up for renewal. And with respect to that, the challenge is these mortgages at the time they were taken out, they did qualify at higher rates just based on the mortgage underwriting rules. So in terms of maintaining credit quality, we anticipate that to be adequate. But the challenge, of course, is less cash that people would have to spend on other things. And yes, I think that ultimately is the goal of monetary policy, is to slow the economy. And that's the knock-on effect, and that's the outcome of it. So I would expect that if we get to the point where rates start to go down between now and kind of this onslaught, as you say, of mortgage renewals, we would potentially see that being alleviated if the rates do come down. So I think everybody's paying attention to this because it is a meaningful impact.